Welcome back, YouTube fam. Today, we're diving into the world of finance and taking a closer look at one of the hottest companies on the market, Target Company. Get ready to uncover some mind-blowing numbers and key financial indicators that will leave you amazed. Let's get started. First up, let's talk about the price-to-earnings ratio. The PRTTM, or price-to-earnings ratio trailing 12 months, stands at 22.66 for Target Company. This ratio indicates how much investors are willing to pay for each dollar of earnings the company generates. A PR lower than 15 can suggest that the stock is undervalued. Now, let's look at the forward-looking PR, also known as the PRFWD. It's at an impressive 13.04 for Target Company. This forward projection takes into account future earnings estimates and gives us a glimpse of the company's potential growth. Next up is the PG ratio, or the price/earnings to growth ratio. Unfortunately, we don't have data on this one for Target Company. Why, you ask? Well, negative expectations of EPS, or earnings per share, for the next 5 years lead to a negative result when dividing the PRTTM by a negative number. Moving on to profitability, Target Company shines bright. Their return on equity, or ROE, stands at an impressive 24.5%. This metric shows how efficiently the company is generating profits from shareholder investments. And the return on assets, or ROA, is equally impressive, at 5.1%, indicating the company's ability to generate profits from its assets. Let's talk earnings per share. Target Company's current EPS, or earnings per share, stands at $5.88. This figure represents the company's net income divided by the number of outstanding shares. But what about the future? Well, Target Company is projected to have an average annual EPS growth rate of -7.51% over the next 5 years. Now, let's not forget about dividends. Target Company offers a dividend yield of 3.3%. That means shareholders are earning additional income on top of the potential stock appreciation. It's like getting a little bonus for your investment. In addition, in the last 10 years it has had an annual dividend growth of 11.62% on average, which has meant that in that time the annual amount of dividends has doubled. Profitability is crucial for any company's success. Target Company maintains a solid operating margin of 3.5%, which represents the percentage of revenue left after deducting operating expenses. And their profit margin, which indicates the percentage of profit out of every dollar of revenue, stands at 2.5%. Impressive, right? Let's take a look at the company's performance over the past 5 years. Target Company has seen positive growth in both profits and income, indicating their ability to thrive in a competitive market. This upward trajectory demonstrates their resilience and effective business strategies, being reflected in the total return of the company with respect to the S&P 500, where it has managed to obtain a higher profitability in the last 5 years. Now, let's address the elephant in the room, the average price return over the last 52 weeks. Target Company experienced a slight decline of 7.93%. Remember, stock prices can fluctuate, but it's essential to consider long-term and not to be overtaken and sell your shares when they are at a cheap price. But it is the best time to start buying if overall company health is well. Last but not least, let's talk about market cap, which represents the total value of a company's outstanding shares. Target Company boasts an impressive market cap of $61.26 billion, showcasing their position as a major player in the industry. And there you have it, folks. A comprehensive breakdown of Target Company's financials, revealing their strong performance, solid profitability, and promising future prospects. Remember, investing involves risks, and it's essential to conduct thorough research before making any decisions. If you enjoyed this video, don't forget to hit that like button, subscribe for more exciting content, and share it with your fellow finance enthusiasts. Stay tuned for more fascinating insights. Until next time, happy investing!